Hi, everybody. This is Steve Gorin. Welcome to my quarterly webinar. This one is Strategic Planning for Business Entities After 2017 Tax Reform. So this presents information that's in my fourth quarter 2017 newsletter. For those who might not have gotten it, you can get it from me by emailing me, and you'll see in the very last slide at the end there's a little thing you can click on to be able to sign up for the newsletter and get everything. So the program is CLE certified, and CLE certificates will be sent once we verify attendance. If you're seeking CLE for this webinar and you're just attending remotely, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, please write them down, as you will need to provide them in the verification form included in the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. I will be taking questions during the webinar, and in order to ask a question, please open the chat box by clicking on the chat bubble in the top right-hand section of the screen. You must log in with the same email address you used to register for the seminar. This login is proof of attendance and supports our awarding CLE. If you need to leave the webinar, you should log out, and when you return, log back in. The webinar is 1 hour long, but if questions come in after my end time, I'll remain on the line for a few minutes. So, on to the webinar. So tax reform, before getting into the substance of the webinar, I need to give you a quote from Senator Russell Long. And he did this decades ago, but it's true, and it's true today, and it was always been true. This is a guiding principle of every tax reform bill that has ever been passed. And that is, don't tax you, don't tax me, tax the man behind the tree. And you will see as we go through this that is very much the case. We're going to talk about the impact of the new tax rates for C corporations and the 20% deduction for pass-through entities. And we will talk about how these rules change the paradigm for transferring a business. We'll talk about strategies for changing the business's entity status when the rules change again. We will talk about the type of entity. We will talk about corporate level tax savings combined with the level of dividends distributed to shareholders. We'll talk about the 20% deduction. We'll compare S-corps to partnerships. We'll talk about real estate a little bit. We'll talk about the application of the pass-through deduction to trusts. We'll talk about whether to use a C-corp for long-term investments, and we'll talk about conversion strategies. So your code word on the next slide is the word cut, because this is a tax cut. It could also describe what happens to your hands when you handle too much paper, because this is a very long act. Type of entity, I'm sure most of you know this, but I just want to make sure that everybody has the basics down pat. If you're a corporation, you can be taxed as a C corporation where the corporation pays taxes on its income. Or it can be taxed as an S corporation. In that case, instead of the corporation paying tax on its annual earnings, the corporation will issue a Schedule K-1 to its shareholders, and the shareholders report the income on their returns. So generally, the S corporation does not pay tax on its annual earnings. Its shareholders do instead. You can have a partnership taxation, and one of the most popular ways nowadays to be a partnership is to have a limited liability company, an LLC. So if it has more than one owner, then it is taxed as a partnership unless that makes a special election. Or you can have a limited partnership, and a limited partnership is a partnership where you have one or more general partners who control everything, and one or more limited partners who are just investors along for the ride. They might participate, but they don't have a right to in their status as limited partners. And actually, I think that when you have a business of any significant size, and if you can have it be in partnership form, making it be a limited partnership is the best. And we'll see what kind of time I have to go into that. So a limited liability company, or LLC, if it has more than one owner and does not make a special election, then it is taxed as a partnership. If it has only one owner and does not make a special election, then it's a disregarded entity for income tax purposes. So for income tax purposes, the owner reports it directly on the owner's tax return. A limited liability company can also elect corporate taxation and can be an S corporation or a C corporation. So we've gotten into this new paradigm with C corporations, probably one of the biggest tax cuts for C corporations in the history of our country, going down from a 35% federal income tax rate to a 21% federal income tax rate. Now, before tax reform occurred, we did have C corporations at lower tax rates than pass-throughs. Typically, you'd have a 35% tax rate for a C corp, and the pass-through tax rate would be about 40% or so. So there was a small differential. Now, the top rate for a pass-through is about 37%. We'll talk about how that can be reduced or increased in a moment. But you compare that 37% plus or minus, you compare that to 21% federal for a C corporation, and you can see that people are going to be motivated to say, gee, should I be a C corporation and pay only federal tax of 21%, or be an S corporation or partnership and pay tax at a significantly higher level? And we'll talk about the pass-through rate in a few minutes. So the real question for that is, are you leaving the money inside the C Corp, or are you distributing it out? And I'm going to go through with you 3 paradigms for whether you're making current distributions or not. And in each of these paradigms, I'm assuming not only do you have a federal rate of 21%, but you're in a moderate state, which is 5%. So if you look on slide 7 in the left-hand slide, left-hand column, we have individual in the top bracket. So the first few lines are just at the corporate level. So it doesn't really matter what bracket the individual is in. So at the corporate level, you'd have $100,000 taxable income in the example, and you have $26,000 of federal and state income tax, so that's 21% federal plus 5% state equals 26%. So you lop off $26,000 of federal and state income tax, and you have $74,000 left over. Now, in this first example, we're distributing 100% of the corporate net income to the shareholder, and so the shareholder is going to get a $74,000 dividend distribution. And again, if they're in the top bracket, you have the 20% federal rate, you have the 3.8% net investment income tax, which is automatic for C corporation dividends, and you have a 5% state rate. So that adds up to the 28.8%. And by the way, with all these assumptions, if you look at the top of the slide, you can see there's a reference to Roman numeral 2E1A. So if you were to just copy that from your slide and paste it into the longer materials, you should have downloaded the slides and also 1,570 pages of materials. And if you go into that PDF with the 1,570 pages and you put into your search feature the 2E1A, just copy and paste it from the browser, you can go directly to 21EA, and that will show you all the assumptions. Also, my newsletter goes through these assumptions and has all these cross-references too. And it's really a narrative of what I'm saying orally is in my newsletter. So we've got this 28.8% tax rate for somebody in the highest bracket. So if you take 28.8% of $74,000, that's $21,312. You subtract that from the 74, and there's $52,688 left over. So if you take that compared to $100,000, that's a combined income tax rate of 47.3%. Now, if you have somebody in the modest bracket, so we go to the right-hand column, again, the first 3 rows are the same because that's the inside corporate tax, so there's $74,000 left over. Now I'm going to apply a 20% rate to the person in moderate bracket, 15% capital gain rate that applies to qualified dividends, and 5% state. So they would pay $14,800 in federal and state income tax on their $74,000 dividend, and there's $59,200 left over. So the total tax for that is 41.8% if you compare the $59,200 to the $100,000. And on slide 8, we are distributing half of the corporate net income after income tax. And the first 3 rows are the same. The $100,000 corporate income tax minus $26,000 federal state income tax equals $74,000 left. So now we're saying out of the $74,000 corporate net income, $37,000 is distributed and $37,000 is retained inside the company. So you take the $37,000 distribution to the owner, you apply 28.8% tax at the highest bracket. That comes out to $10,656. So if you subtract that $10,500 off of the 37, we have $26,344 left over in the individual's hands. The corporation still has $37,000 that reinvested. So the corporation and the shareholder together have $63,344. So there we have a tax rate of about 36 2/3% on a current annual tax. Now, if you take an individual in a modest bracket, again, on the right-hand side, we have the same types of things. 100 minus 26 equals 74. 37 gets distributed out. If you take 20% of the $37,000 distribution, there's $7,400 left over. I'm sorry, $7,400 of tax. So you subtract that from the $37,000, and there's $29,600 left over in the individual's hands. Add that $29,600 to the $37,000 that the corporation reinvested, and you have $66,600 left over. So that's an effective rate for a modest person of about 1/3. Now go to slide 9, and the corporation has $100,000 of taxable income and simply pays $26,000 of tax and has $74,000 left over. So that's only a rate of 26%. Now, that looks very attractive, but if you're the shareholder, you might not be too happy at getting 0 from your company. And certainly if you have a trust and you have the company inside the trust, beneficiary is going to say, show me the money. And they're not going to be too happy because they get no good out of reinvesting that money. Now, they could sell it later on, but what happens if you sell it? If you sell it, that reinvested $74,000 is going to be part of the sale price, and you're going to have to pay capital gain tax on that. That capital gain tax would be the same as that dividend tax. So really, it's a matter of pay me now or pay me later. So if we go back to slide 7, so on slide 7, what we're really doing is in the left-hand column, we're paying $26,000 now and $21,000 later when you sell your company. So you're still getting the double tax. It's just that we are deferring the double tax. So now let's skip on to slide 10, and let's do a comparison. So on the left-hand side, what I've done is I've taken the first 3 rows are just taking from slides 7, 8, and 9. So on the left-hand side, we have a 47.3% effective rate when you distribute all of the corporate earnings, a 36.7 short-term rate, and a 47.3% long-term rate if you distribute only half of it. Or if you distribute none of it, we have a 26% short-term rate, and again, a 47.3% long-term rate. Now, let's compare that to an S corporation or partnership or sole proprietorship. And you can see for the individual top bracket, I have a range here of 34.6% to 45.8%. And again, I'm going to go through my assumptions, but you can see at the top it says 2E1. So if you went to 2E1 in my supporting materials, you would see all the assumptions written down. So you can go back later to look at them. So here are my assumptions for an individual in the top bracket. On the low end of the spectrum, the person would pay 37% top rate, would have a 20% deduction for the pass-through, and we're going to get into that 20% deduction in a few minutes. But if you take 37% top rate times 20% deduction, so 37% times 20% is 7.4%. So if you take the 37% top rate and lop off 7.4% for the 20% deduction, you come up with 29.6% for the federal rate. And then we add on 5% of state income tax. So 29.6 plus 5%, that's how I get to my 34.6%. Now at the very, very top end, for an individual in the top bracket, we have a 37% federal rate. We have no deduction for the qualified business income. We have a 3.8% net investment income tax or self-employment tax. So 37 plus 3.8 is 40.8%. We add a 5% state income tax to get up to a 45.8% rate. So you can see for an individual in the top bracket, if you compare the annual burden, we have 47% or 37% or 26% for the C Corp on a short-term basis compared to the 35 to 46% for the pass-through. Now, in the modest bracket, again, those numbers on the right-hand side come from the prior slides, 40.8%, 33.4%, or 26%. In the modest bracket, we're assuming a 5% income tax, 15% income tax rate, and then your self-employment tax would be 15.3%. Now you get a deduction for half of your self-employment tax. So I'm taking that into consideration. You also have your 20% deduction, and then you also have your state income tax. Actually, I'm sorry, I got that backwards. I was doing a 28% bracket. I was looking at the right-hand side. So back up, reverse, start over. 28% bracket, take off a 20% deduction of that, so it's 5.6%. So 28% minus 5.6 is 22.4%. And then I was adding 5% of state income tax to get 27.4. So I was assuming no self-employment tax, no net investment income tax. And you can do that if you're in an S Corp or maybe if you are a limited partner in a partnership. Then the maximum bracket was, for that individual, was 28% minus 5.6% plus self-employment tax plus state income tax to get to the 46.2. So an individual in modest bracket, you can see they may be very well paying not much different than the C Corp that reinvests all its income, if they're in the lowest end of that. And the upper end, they could be paying higher. In fact, in the upper end for a person in the modest bracket with the self-employment tax, they might be paying a higher marginal rate than a person in the top bracket. And that's because I'm assuming the full self-employment tax applies to this money, whereas the individual in the top bracket has already burned through the self-employment tax, and their marginal rate is the smaller amount, the 3.8. So on a short-term basis, we have significant savings by being a C Corp if you don't distribute anything. And we're going to talk about a little bit later whether the C Corp can get away with not distributing anything. But if you think in the long term, you're really in that upper line, 47.3% or 40.8%. if you count the capital gain tax on the sale. And you can see in the long term, the individual in the top bracket is definitely better off being a pass-through. And in the long term, they're better off being, in the modest bracket, they tend to be better off being a pass-through. Okay, so let's go to the next code word, and that is transparent. Because we're talking about the pass-through deduction in just a moment, and so that transparent is what we're talking about. So actually, I wound up getting, we're on slide 11 now, I wound up getting my slides backwards because of declaring dividends. I'm going to talk about that first before we talk about the pass-throughs. So professional firms tend to distribute all profits, so they're not going to be reinvesting. A sale to an irrevocable grantor trust. So let's talk about for a minute how the sale to irrevocable grantor trust works. So the sale to the irrevocable grantor trust, what you're doing is you normally are doing this with an S corporation or partnership, and the grantor will do a seed gift and then will do a sale to this irrevocable trust in exchange for a note. Now, an irrevocable grantor trust is a trust that is outside of the estate tax system, but for income tax purposes, the grantor is still deemed to own it. So you have the setup is that the S corporation stock or partnership interest is inside the trust. The trust is going to be receiving distributions from the partnership or S corporation, but the grantor is going to pay the tax. Now, on an annual basis, as a general rule, S corporations and partnerships will distribute enough to their owners so that the owners can pay their tax on the owner's share of the S corporation or partnership's income. Remember, I said that a partnership or an S corporation will give a K-1 to its owners, and the owners pay tax on the business entity's income. So normally, an S corporation or partnership will make a tax distribution to its owner, and then the owner uses that money to pay Uncle Sam and the State Department of Revenue. Now, a sale to an irrevocable grantor trust has a very magical cash flow here, because when the S corporation or partnership makes a tax distribution to the trust doesn't have to pay taxes. The grantor is paying the taxes. So the trust uses that tax distribution to repay the note, and then the grantor uses the note repayment to pay Uncle Sam and the government. So what's happening is that the tax distributions are paying down the note. They're giving the trust equity by paying down the note. That money goes to the grantor, but it disappears because it's going around right to Uncle Sam from the grantor. So what happens if you have a C corporation? Well, the C corporation does not make tax distributions because it pays its own tax. So instead of its taxes instead of the tax distributions going to the trust and then the trust paying off the note, that money for taxes is going directly from the corporation to Uncle Sam and the Department of Revenue. And so what's going to happen is that that money is not available to pay down the note. And furthermore, what's the only way that the corporation is going to be able to get money out to pay down the note? That's through a taxable dividend. Well, now you're back in those prior slides with a taxable dividend that you've got the 47.3% or the 40.8% tax rate. Again, probably the 47.3% rate is going to be applying, so you're not getting the benefit from this from the tax. So a sale to an irrevocable grantor trust is pretty much a non-starter. There are strategies to try to cope with it, but those are not very tax efficient. Sale to irrevocable grantor trust doesn't work. Professional firms don't work. There's something called a personal holding company tax. So if the company just has investment income and it's not engaging in a business, then it may need to pay what's called a personal holding company tax on the personal holding company income. That's a 20% federal tax. And how do you get out of the tax? By paying a dividend to your shareholders. Now, if you are an active business and you don't have personal holding company tax, then you may have accumulated earnings tax. So if you accumulate more money than you need for your reasonable business needs, then you're going to have an accumulated earnings tax. And again, that's a 20% tax, and you can get out of it by paying dividends. So we have a question, is it fair to assume that the personal holding company provision does not apply to corporations as an active business? And so the answer is that yes, we'd have the accumulated earnings tax potentially. And a C Corp can accumulate non-U.S. earnings free of the accumulated earnings tax, and if so, how do you trace? I'm not talking about non-U.S. earnings here. That's well beyond the scope of this discussion. There are provisions in our tax law called controlled foreign corporations, and there's other related foreign tax things. So you're not going to get a free pass if you're a foreign corporation. But that's something again that's beyond the scope. So consult your international tax experts on that. Now we will talk about pass-throughs. So there used to be a deduction for domestic productive activities. Basically, that was a 9% deduction that was aimed at then giving you a 3% income tax bracket reduction. That deduction is out the window now, and instead we have this deduction for qualified business income. That's for taxable years starting in 2018 and going through 2025. So that's a temporary deduction. It applies to an individual or trust that owns a partnership interest, S Corp stock, or sole proprietorship. The deduction is up to 20% of qualified business income, and we're going to get into what that means. Each trade or business must be separately tested. As an aside, it lowers the threshold for you becoming potentially subject to an underpayment penalty if you have an understatement on your return. I'm not going to get into that now. If you look at the materials, again, the 2E1C does refer that, and it gives you more details on that underpayment penalty. So slide 13, types of income and activities eligible for the deduction. It must be a qualified trade or business. So it has to be a trade or business, and it has to be within the approved list. Each business is tested separately. There's no guidance on how to delineate. And my materials, they're listed in there, 2E1CII, they speculate how the IRS might be delineating, but that's only pure speculation. I don't have an inside track, nor does anybody else. Now, you do not include compensation for services rendered, and specifically, Congress had in mind a salary to an S corporation owner employee. So when the S corporation owner pays himself salary, that salary is not eligible for the deduction. So we're going to talk about that a little bit later. Also, it does not apply to guaranteed payments from partnerships. So suppose you have a partnership and some of the partners are providing services to the partnership, and you want to pay them a salary. So that salary is not W-2 because partners can't pay W-2s, but that salary is called a guaranteed payment. And that salary, a guaranteed payment also can be a percentage of gross receipts. It's not a percentage of profits. If it were a percentage of profits, that's not a guaranteed payment. Or if it's a percentage of receipts, like, for example, you manage real estate, you get paid a percentage of the gross rental income. So your percentage of the gross rental income would be considered to be a guaranteed payment. So that does not qualify for the 20% deduction. And if you're receiving a payment for services as an independent contractor, the fact that you're getting that with respect to a qualified business does not mean that you get to get that the 20% deduction on that as well. I said it needs to be a qualified business. So there are specified service businesses. So the specified service businesses, there's really two lists, and I have one list on slide 14 and one on slide 15. On slide 14, you can see that I have the list, and this list comes from a particular other code section, comes from code section 1202, and you can see there that there's a list, basically personal service types of things. And you can see I have engineering and architecture crossed off. So all these personal services people are disfavored businesses, but the real estate lobby was strong enough that they were able to say, well, engineers and architects, they do get to qualify for the deduction. They don't have the same restrictions as other service businesses. So don't tax you, don't tax me, tax the man behind the tree. You see that at work right here. Now, if your taxable income is below a certain threshold, then your business does qualify. So let's suppose that you were, a partner in the law firm, and you made a couple $100,000, then your taxable income is probably going to be below that threshold, and you'd be able to get the full deduction if you're receiving a profits interest. So if you're below the threshold, then this blacklisting does not apply, and you can get the 20% deduction for these businesses. Now, if you go to slide 15, those are businesses that it doesn't matter what your income is. You can be somebody who's barely breaking even. If you're in these businesses, basically this is like your broker dealer, your financial institution. So if you're somebody who is advising clients directly, and you get your money by advising clients directly, well, then you're on the prior slide, and if you have a low enough income, then you can get the deduction. But if you're like doing day trading or stuff like that, or you're making money off of other people, then you would not be able to get that deduction. So no matter what the threshold is. So on slide 16, calculating the deduction generally, I'm going to pass over that. It's just there for your later reading. I'm going to also pass over slide 17, and we're going to go on to slide 18. So the bottom line for each separate business, you're going to look at 20% of the qualified business income, okay? But that is capped at the wage limitation. I'm going to explain the wage limitation in a minute. But the wage limitation does not apply when your taxable income is below the thresholds, which I'm going to get to in a few minutes. So you have the qualified business income, but that can be reduced by a wage limitation. So slide 19 is your wage limitation. You have two alternative ways that cap your deduction. So again, the deduction is the lesser of the 20% of your qualified business income or the number on this slide. So the number on this slide is either 50% of the W-2 wages with respect to the qualified trader business, or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. And we're going to talk about those components on the next slides. So slide 20, W-2 wages, those actually are what appear on the W-2, and it needs to be on a timely filed W-2 filed with the Social Security Administration. Slide 21, when I talked about the 2.5% of the unadjusted basis depreciable property, that's property held by and used in the business at the close of the taxable year, needed to be used to produce a qualified business income. The depreciable period cannot have ended by the end of the close of the taxable year. So the depreciable period is the greater of 10 years of the class life. So to give you an example how that would apply, if you have a desk that has a class life of 5 years under the depreciation rules, so the greater of 10 years or 5 years, if you still have that desk around after 10, in 10 years, in that 10th year, you still get to count that desk even though it's been fully depreciated. And then once that 10 years is up, you should argue for a new desk. Now, if you have a building and that has a life of, say, 30 or 40 years, well, the greater of 10 years of the life would be the 30 or 40 years. Qualified property. it says the unadjusted basis. So that implies you capitalized the basis. So we don't really know for sure how this works, but my best guess is that that requires capitalization, and if you're taking Code Section 179 expense, that was expensed and not capitalized, and therefore Code Section 179 property appears not to qualify. On the other hand, there's bonus depreciation, and now with the tax reform, we have 100% bonus depreciation on certain property. And that bonus depreciation does not have a lot of the limitations that apply to Code Section 179. So when in doubt, if you have a choice between 179 depreciation and bonus depreciation, take your bonus depreciation and write off 100% of the property if it is eligible. Now, my slide there, the 2E1C3, when you go into my materials that you download from the web page, or from the actually your email that's sent around for the login information has the download there in that email. And so if you go to that email for the download, and by the way, this will be on the web page too. It's not posted there yet, but it will be there. So those of you listening to a recording after the fact, it will be on the web page. So so if you go into that section of it, I talk about where bonus depreciation is located, and there's a link to a different part of my materials, and my materials go through what is and what isn't eligible for the 100% bonus depreciation. Taxable income thresholds. So again, these are the thresholds that let certain businesses qualify. If they're blacklisted, then they can qualify if your income is below these thresholds, or if you have or you can skip having the wage limitation. So maybe you're a small business owner, maybe you're the only person working in the business. So let's suppose you're the only person working in the business earns $100,000, you don't have any employees, you're not going to meet the wage limitation. But if your taxable income is low enough, then you don't have to worry about the wage limitation, and you can take the whole $100,000. So here's the taxable income thresholds. $315,000 for married filing jointly, and then that gets phased out between $315,000 and $415,000. So during that $100,000 range, you would get a benefit for a pro rata portion. So only part of the wage limitation would reduce your qualified business income. Only part of the business income would be ineligible for the deduction. And those benefits apply cumulatively. My newsletter has an example, and so does that material. The 2E1C5 takes you through some math on how you would apply those limitations. And we're going to compare S-corps to partnerships. So let's suppose you have $300,000 of qualified business income before considering the owner's compensation. Let's suppose that reasonable compensation would be $200,000 or more, and that $200,000 is actually distributed to the owner. An S corporation, you're going to have to claim that $200,000 as W-2 wages. And by the way, in the spring of 2017, the IRS told all of its examiners that it figured out how to keep taxpayers out of tax court if they want to contest it. So if the IRS comes in and says, you distributed $200,000 and that amount was reasonable compensation, you need to pay FICA on all of that, then you can't say, well, I'm going to go to tax court and fight you there. The IRS now has a procedure to keep taxpayers out of tax court. Now, it didn't really wise up to this procedure until recently, so there are prior tax court cases on reasonable compensation for in the S-corp arena. But going forward, you should expect that for anybody who's getting audited in 2017 or later, that they will not be able to go to tax court. That they were going to have to pay the tax and sue for a refund in district court or claims court. So anyway, So the S corporation is going to have the $300,000 of income and subtract off $200,000 of wages. So there's $100,000 of qualified business income left. So only the $100,000 counts toward the 20% deduction. Now, on the other hand, if you had been a partner with a profits interest, or maybe you were a sole proprietor, you had $300,000 of this income from your sole proprietorship, okay? So that's the whole amount. So an S corp is at a disadvantage relative to partnerships and sole proprietorships. And by the way, again, if you go into a limited partnership, you can get a lot of the benefit of an S corp for your distributive share of income. So again, I don't know if I'll have time to get into that, but you can look at my material. My materials go into what I view to be the ideal structure for that. Now, even though there was a lot of publicity, now we have all these provisions for real estate. We saw that the real estate lobby was able to get engineers and architects to qualify as businesses. We see that they have a special rule for them to be able to count depreciable property toward the wage base. So one thing that didn't make it in there, or there's no exclusion for it, is the Code Section 199A deduction applies only for a trade or business. Now, what is a trade or business? I don't know. It's like the Supreme Court defining pornography. It knows it when you see it. Now, to give a story, the last time taxpayers really asked the IRS for a lot of guidance is in the net investment income tax area. Because under the passive loss rules, if you're a real estate professional and you have real estate trade or business, then you can count that as non-passive income. It's non-passive income, therefore it doesn't get hit with the net investment income tax. So when the IRS put out proposed regulations and then final regulations for the net investment income tax, taxpayers were asking, well, you know, we want to know what the guidelines are for whether a real estate person can count as a trade or business, because we want to know whether we're going to have to pay net investment income tax on it. And the IRS said, we're not going to tell you. It's case law. But they said, let's talk about what case law has basically some general principles for case law. So the preamble said, here's what we think it is under case law. And they talked about different factors, and you can see on the slide what the different factors were. But I'm going to focus on the very last two lines of this slide, a net lease versus a traditional lease. Okay. So here's an example, very common. You have an S corporation, and the real estate is owned in an LLC outside of the S corporation. We have a single LLC. It's owned by the same people who own the S corp oftentimes, and that LLC just has one purpose. It has one piece of real estate that it leases to one business, and it does it on a triple net lease. And under this triple net lease, the S corp is paying all the taxes, all the insurance, all the maintenance, all the repairs, the janitors, everything. And the real estate LLC is sitting back and just collecting a rent check. If that's the case, then I'm very confident that the IRS is going to say that that is not a trade or business. So what might you do if you're in that situation with one triple net lease on one property to one tenant? If it's all the same owners anyway, then who cares who is doing what as a practical matter? So have the real estate LLC pay all the bills, have it pay all the utilities, have it pay the the maintenance, have it pay the taxes, have it pay the insurance, have the LLC hire the janitors, hire the maintenance people. Okay, hire anything that would be reasonable for a landlord to do. Have the tenant reimburse the real estate LLC for that, okay? So there's the same net cash flow going to the real estate LLC that you always had, but you have a lot of activity going on there. And my materials do go into a lot of cases on real estate LLCs, and it has citations to articles on it, some excellent articles on it. And there are cases that do say that if you have one piece of property leased on a long-term basis to one tenant, you can have that be a trade or business. So just take a look at it. It might not make sense to reallocate all these duties. You might have somebody who's a triple net lease and they just don't have a relationship with a tenant like that. They just might not want to do the hassle. You might have a portfolio of triple net leases. Maybe you might take the business in the portfolio as an active trade or business. I don't know whether that will fly or not. I just can't say. I don't have an opinion on it one way or another. So I just wanted to throw it out to your consideration that you should be reviewing the leases, and any CPAs out there, take a look at that. If you're a trust advisor or an attorney, just ask the question and throw it over to the CPA to resolve it for the client as to what the CPA wants to take a position will qualify as a business. Trust and qualified business income, grantor trusts are disregarded, and their items are attributable to their deed owners. So that's kind of a common sense result. Now, what if you have a non-grantor trust? So the trust is paying tax on its own income, and it distributes part of its income to its beneficiaries, and part of it keeps. So with the taxable income, and I'm going to kind of shortcut this. I'm not going to do a total technical description. But basically with the trust, you determine the trust taxable income, and then if you distribute that to the beneficiaries are taxed on that instead of the trust being taxed on it. So the trust gets a distribution deduction for the money that it distributes to the beneficiaries. So the taxable income before the distribution deduction is calculated is called the distributable net income, or D&I. So what you do is you look to see what the trust D&I is, and then how much went to the beneficiaries and how much did the trust keep. So you figure out what percentages, and you apply those percentages to all of the items of qualified business income. The qualified business income, the wages, the depreciable property, you apply to all of that. And then at the beneficiaries level and the trust level, you will separately do your calculations, and you apply your separate taxable income at those levels. Now, I had one trust company say, all of our clients are super rich. We're all going to always be above the thresholds. Why are you bothering me with this, Steve? So, well, their clients might be super rich, but the kids might or might not be. And you could create a separate trust for each child that holds this qualified business interest. So you might have an S corp or partnership that generates a lot of income every year. Maybe you give a separate non-grantor trust for the son, and that trust might receive like $150,000 of qualified business income, gets the full deduction. Taxable income is below the threshold. You don't have to worry about the wage limitation or what kind of business it is, and you get the full benefit of the deduction for the son's trust. And you give daughter her own trust, and that's a non-grantor trust. It gets its own threshold. Maybe the trust, instead of getting $150,000, gets $300,000. It keeps $150, and it distributes $150 to the son or $150 to the daughter. So now you have the taxable income threshold for the trust and for the son and for the daughter. You might have two trusts, and the son and daughter, you might have 4 different thresholds there. So income splitting can work with this and get you the full benefit of your thresholds if you're concerned about the wage limitation or the quiet type of business. Let's go to slide 27. This just talks about trust in 2017 law. And I'm just I'm just leaving this for your consideration. Some of these ideas go hand in hand with the slides on the prior slide. The next slide is our third code word, which is strategy, because we need to figure out what the long-term strategy is going to be. Should a high bracket taxpayer put long-term investments in a C Corp? Okay, so first of all, dividends that a C Corp receives from another domestic C Corp have only a 10.5% federal income tax rate, because half of it is excluded. There's a dividends received deduction of 50%. It was higher before they changed the law. With the tax reform law reducing the rates, they also reduced the deduction. So only half of your C corporation receipts of dividend income is subject to income tax, so you have a lower rate for that. And think about taxable interest and capital gains. Those would have the federal income tax rate of 21%. Contrast if you have taxable interest or a short-term capital gain. In the top bracket, those are going to be taxed at 40.8%, 37% for the top bracket and 3.8% for net investment income tax. And then for the top individual bracket, 23.8% on qualified dividends and long-term capital gain. You can see that 23.8% for an individual and qualified dividends versus 10.5% for the federal income tax on it inside the corporation. That makes the C Corp attractive. So do you consider doing that? You get another benefit is investment management fees are deductible to a C Corp but not to an individual. A C Corp, they're simply deductible. An individual, they're miscellaneous itemized deductions, and we have a temporary disallowance of all miscellaneous itemized deductions under tax reform. So you can get an extra benefit by being a C Corp, but you've got the personal holding company tax to worry about. And if it's not a personal holding company, then accumulated earnings tax. And if you just have a mere investment company, then if you accumulate more than $125,000 of accumulated earnings, then you're going to have to start paying a dividend. You might have the high tax bracket taxpayer, but how they can get the money out. Again, the beneficiary says, show me the money. So you could convert to an S Corp later, and I mentioned there a disadvantage to that. Another issue is that on the death of the primary beneficiary, you can't do a tax-free split up with a C Corp if it's just an investment company. You can only divide up trades or businesses. If you do a conversion from an S Corp to a C Corporation, you may need to convert from cash to accrual method if there's more than $25 million of gross receipts and you're not a qualified farmer or personal service corp. So if they do convert and their cash method, they may need to go to accrual, and so that conversion would trigger income tax. You might consider distributing a note before year end, and this is the thing I was kind of talking about for the irrevocable grantor trust. Before you convert from an S corporation to a C corporation, you distribute a promissory note, and so then you can be distributing out your S corporation earnings, your AAA, and so then you have a promissory note, and then you can repay the promissory note. The problem with that strategy is the interest on the promissory note. The federal interest deduction the corporation receives is 21%. The federal income tax rate that the person receiving the note is going to pay is 40.8%. So 40.8% by the recipient of the income, 21% by the payer. That is not a good deal. Also, if you do the S to C conversion, if you distribute cash in the first C corporation year, that can count as distributing out your S corporation earnings only in your first C corporation years. There is also kind of a phase-in on something else, but I'm not going to go into details now on that. If you convert from an S corporation to a C corporation, so here's the issue. First of all, I'm a firm believer in the idea that Congress is going to pull on us a bait and switch. Now, I'm not saying that the Republicans intend a bait or switch, but But here is what is going to happen. The Republicans say, we love having a low C Corp rate. The Democrats are going to say, C corporations don't need a rate so low. Now, it is true that Hillary Clinton's campaign and the Democratic platform did call for a cut in the corporate tax rate, but not one as low as we have today. And we do have huge deficit issues. This current tax bill is projected to cause an additional $1 trillion added to our debt. And we have Social Security turning into a huge cash drain, and Medicare is in a bad state too. And also when people get older and poor, we've got Medicaid issues, and how are these people going to pay for the nursing home if they don't get Medicaid? So we have big deficit issues. I think that at some point they're going to raise C Corp rates back up. I don't know whether it's going to be 35% or not, but that will change the calculation, and it will make C corporations unattractive. And so you may want to be converting back to an S corporation. So if you do that, let's suppose you had earnings and profits. I'm sorry, you had a AAA, you had S corporation earnings, and you want to preserve that so that later on, when you convert back to an S corp, you'll have those AAA available to distribute. So I talk in here a procedure you should be going through before you do your C corporation conversion. So anybody who's an S corp and you're not distributing all the S corp profits out now, there is a procedure you should go through. I'm going to lead you to the materials. There's a built-in gain tax if you convert back to an S corp. And let me just give you like a horrible scenario here. You're an S corporation, you have a zero basis property, it's worth $1 million right now when you convert, before you convert to a C corp. So in all fairness, that $1 million, a built-in gain was earned as an S corporation. But you don't sell the asset, you still have that asset around, so you have this property with $1 million of gain inherent in it. Then you do your conversion to C corp, and it appreciates to $1.2 million. If you sell that for $1.2 million, you're going to have a $1.2 million corporate level gain subject to C corporation tax, even though only $200,000 of the appreciation occurred as a C corp. And furthermore, if you can, let's suppose you don't sell it during the 5 years that you have it before you convert back to S corp, and then let's suppose you convert to an S corp, and then you sell it sometime in the next 5 years. So between years 6 and 10, you sell that property. You're going to have the whole $1.2 million subject to the built-in gain tax, even though only $200,000 of that appreciation was as an S corp. So you've got problems. There are problems there. There are other issues in distributing profits when you used to be a C corp, and I'm going to leave that to your reading, but I just want to point out that an S corp that's pristine is a lot simpler to deal with than an S corp that used to be a C corp. So if you go S corp, then C corp, and then back to S corp, you're going to have some C corp pollution that occurs, and it's going to make things a lot harder on you. You might consider splitting up your business. Maybe you would have a limited partnership with a C corp or general partner. So the C corp is allocated the profits that are intended to be reinvested. The limited partners allocate the profits that are intended to be distributed. So that way the C corp can get the full benefit of reinvesting the earnings, and you can get your distributions out through the limited partnership. It's easier to start off with a partnership and get into this than it is to start off as a corporation and get into that. And again, I commend you to the materials for that. So we are pretty much out of time. I'm going to go on. I do have other things that have occurred in my slides, and I just commend those to your reading. And let's go to the very last slide, which is slide 40. So I've got a webinar on fiduciary income tax on February 14th with my partner, Laura Duncan. That's an hour worth of things on tips and traps. And I encourage people who, if you draft trusts, you should really understand what the rules are for trust income tax so you know what you're getting your clients into. And if you're a CPA, you're going to want to do that just as a refresher on what the rules are. And we do include some kind of creative planning in that as well. My first quarter newsletter will have an April 24th webinar, just like this one. I encourage people to sign up for my blog. Heckerling, the ABA Real Property Trust and Estate Law section, has people who report on the Institute, and I get those reports, and then I forward them with comments on them to whoever wants them. If you want to sign up for that, you can just click on that link and sign up for that report. And finally, if you don't subscribe to my newsletter, I encourage you to do so and click on that last link at the conclusion. So I hope that you found this helpful. And, you know, we had a promise that they're going to fix our broken tax code. I leave it to you to determine whether they actually did fix our broken tax code. But here is the definition of a tax advisor, which is ever so true, I believe, under this new law. A tax advisor is someone who solves a tax problem you didn't know you had in a way you don't understand. Look forward to our next webinar. Thank you.